Wonderful. Hello, hello. Welcome, everyone. I am Mandy McAllister. I will serve as your host today with the brilliant Karen Hall. I'm excited. Oh, we get Julie. My girl Julie made it. Hey, Jeannie. Hello. The dancing real estate lady herself, Miss Julie Ann Peterson.
Oh, she's
One
the
of my best.
bomb.
Oh my gosh, this woman. I can't even. I love it. Jeannie, so excited you're here too. Very cool. Well, we are recording this, so we will be sending out to everyone who registered. So I'm going to go ahead and just get this party started. Guys, I have had the opportunity to become friends with the woman who will be speaking with today, the expert on self-directed IRAs, Karen Hall. She is the CEO and founder of UDirect IRA. She started that based on her 20 plus years in mortgage, and she brought her brilliance into helping people invest their dollars in a way that makes more sense. And she, like me, is obsessed with the idea of especially empowering women to make more happen in real estate. So, Karen, hello, my friend. Thank you so much for joining me today.
Hey, Mandy, so great to see you. Last time I saw you, I think we're both on a catamaran. Am I right?
Yeah. Yeah, we have a big old adventure, a catamaran in Costa Rica.
Yeah, it's so fun.
Snorkeling for the first time in my life, 43 years. So awesome. So the real impetus of this, the purpose for putting this on is, I have an opportunity to mentor people who invest in real estate and specifically small apartment buildings. And one thing that kept coming up was, ideas of how do I use my self-directed IRA funds to invest in these deals so that, I can lean on real estate to grow my wealth. But before we really dive into mistakes that can happen and things like that, why don't we back up completely? So for someone listening to this, let's zoom completely out. What does it mean to self-direct an IRA?
It's just the simplest thing. It's to take your retirement dollars that you've saved and to move them into a self-directed account and then invest.
One more time, Karen.
It's just a matter of moving your retirement account into a self-directed account so that you can invest in alternative assets. And we can talk about fees. We can take all your questions, anything you want to know. That's what we're here for.
I love it. So the plan, guys, is I have a couple of questions I want to make sure we cover, and then please put yours in the chat or I'll have you come off mute and we'll answer all the questions that you've got. But you mentioned alternative assets. So if I just have a normal 401k or IRA through an employer, the 401k through an employer, or put money in an IRA, I normally think mutual funds or stocks, right? So
yes.
If I choose to self-direct, talk to me about what those assets are, those alternative assets that I might be able to invest.
Yeah, I mean, the blanket kind of term for that is anything that isn't market correlated, anything that isn't tied to the stock market. So of course it's real estate, but real estate takes so many forms, right? It could be raw land, it could be mobile home parks, it could be multifamily, it could be just so many different things. It could be notes that are secured on real estate, and then take a step back, it could be performing and non-performing debt where the note is the asset, not the real estate, and so many other things too, including cryptocurrency, very high degrees of purity for precious metals. Like a Krugerrand doesn't make it, but like a maple leaf will. So precious metals, you can invest in that. Gold, silver, palladium, which is wonderful to, as a hedge against inflation. People love it. Just so many different kinds of asset classes. But the number one asset class for the self-directed IRA, like as an industry, is private equity, syndications, whatever you want to call it.
I like it. So just while we're on the topic, tell me maybe a couple examples of what I couldn't buy in a self-directed IRA.
Right. You cannot buy a house for your kids to live in. Your IRA can invest in a house, but we'll talk about prohibited transactions. You could not buy, a lot of people want to buy property from their parents' estates. That is a common thing because, if they want to put it in the retirement account, you just have to keep things arm's length. And I think as we go deeper, we'll talk about the rules, what you can and can't do. But otherwise, it's what you can't do is life insurance contracts and collectibles. So when the IRS came out with this, they said, hey, here's a short list, life insurance contracts, collectibles, everything else is okay. But kind of genius in the simplicity there.
I like
But
it.
that's,
Collectibles like art or
yeah. Well, I guess too many fine wine collections turned into bottle collections, and they're like, we got to cut you off here.
I love it. Very cool. What is the weirdest thing you've seen get bought in a self-directed IRA?
Oh man, mango trees maybe,
Huh.
because you buy them when they're seedlings and then they grow, so your assets grow. I mean, it's an alternative asset class. Or maybe we had this one guy. This was a long time ago. But what he did is he bought tickets to the Super Bowl using his Roth, because you may not know this little news flash here that a ticket is real estate. You're buying a
Huh.
ticket to rent that seat. So you've rented a piece of real estate right there. So the guy took his IRA, bought some tickets to the Super Bowl, didn't use them. If he used them personally, it would have been a prohibited transaction.
Right.
But he sold them at a profit. The profit went back in his Roth.
That is stinking brilliant.
Yeah.
That is the coolest thing I've heard all week. Thank you for
You
that
know?
part. I love it. Well, the way I look at this is a retirement account, right? Like this is the whole purpose of this is to benefit me in my retirement years. Like it's
It is.
not meant to benefit me today. If it benefits me today, then I got a problem with the IRS. That is how I let it sit in my mind. So
You're
one
exactly right.
thing that kept coming up with the women I get to mentor was, if I'm doing a deal and I have a partner and I want to bring self-directed IRA funds to this deal that I am putting on with a partner, can I bring those self-directed IRA funds?
Well, the thing of it is that an IRA, a 50-50 business partner is a disallowed person. So maybe we can, mute
Yep.
that person. But a disallowed person would be a 50-50 business partner. That's one of the disallowed person classes. So if they're not 50-50, but the thing of it is so we should just talk about prohibited transactions. So
Yep.
you're not allowed to offer services to the plan. So if it's your IRA, if it's your deal and it depends on what it is. If you're buying a house and you're just having it rehabbed and you've got a crew and they're doing the work, you're not swinging the hammers, you're not providing what we call an over contribution of sweat equity, then yeah, you can do that. As long as the business partner isn't 50-50, yes, you can come in together and do that. But it just depends, like what is the purpose of this deal? Is it for something that you want to use personally? That would be out of bounds. But if it's a rental property that you intend to use for investments, investment purposes only, then you can absolutely do that.
But I want to break this down a little further. So
Yeah.
if I am going to buy a property and fix it up with my own hands,
No.
that is an over contribution of sweat equity.
Yes, it is.
Right.
Yes.
But if I'm going to hire a team and my hands will not touch it, there is potential for my ability to use
100%. Yes. You can hire a crew. Absolutely.
Jeannie, I'm looking at you. I want to make sure that this answers your question because this dives very much into the issue that you are having right now. Do you want to come off mute and maybe get some additional clarity with the expert while we've got her? Oops, sorry. MC, let's take her off mute, I see. I understand that they have a partnership that they're looking to. Oh, Jeannie, MC, take her off mute. We're all to go. But we are currently, I know that this team is currently looking to use self-directed IRA funds in a deal that they're doing. So the person with the self-directed IRA funds cannot use her own hands.
Correct.
Cannot manage the property.
Well, let's talk about that. I mean, here's what you can do. So it's doable, but you just have to follow some rules. So what you can do is you can screen the tenants, obviously, select the property, close it and everything. The IRA will buy it in the name of the IRA. So what you want to do is you can screen the tenants, like who gets to live there. You can have third-party vendors do all the work, and you can go and physically pick up the rent check from the renter and deposit it into your IRA. You can do all these things. What you can't do, again, as we've been saying, is swing the hammers. You can't do the work yourself. And again, it is a prohibited transaction. It's called an overcontribution of sweat equity.
Great. Jeannie?
Yes. So we would be under 50% also because there's 3 of us. So
that's irrelevant.
That's irrelevant. Okay. We're not 50-50 partners. We would be thirds. Does that make any difference at all?
It doesn't. I'm laughing at what Julianne just typed in the chat. She also says, hey, could your husband swing the hammer? Well,
Right.
no, your husband's a disallowed person. So it's disallowed people are your ascendants and descendants, and also you and your spouse. So parents, grandparents, you and your spouse, children, grandchildren, plus a 50-50 business partner is disallowed. And anybody who's a fiduciary, like maybe your realtor has a fiduciary role in the situation, or your CPA or your attorney. Somebody who has that particular fiduciary duty is also disallowed. So no, but just hire the vendors, have them do the work, and you're perfectly fine.
Okay.
So-
And then, I'm
Yeah, go
sorry,
ahead.
go ahead. We would
Yeah.
not be self-managing. We would have a property manager. So that eliminates any question of, what was the word you were using? I'm sorry.
Self-dealing.
Yeah, self-dealing. Okay. I think that answered a lot of my questions. I've been doing a deep dive on this recently, and I'm getting all different answers.
Yeah.
Mhm.
Yeah, so what you can do, there was recently a court case, maybe about a year ago, somebody who was actually taking a fee to be a property manager for their IRA owned property. No, they just lost. That's bad. You don't do that. But just keep it arm's length and you'll be fine.
Okay.
There's also a way, if you do commit a prohibited transaction, you just try to undo it as quickly as possible. That's really the remedy for it. But I've been doing this 17 years, and the amount of prohibited transactions, like real ones that are, where they're talking to the IRS about it, is maybe half a dozen in 17 years, where it really gets that bad. Right now, the IRS doesn't have policemen yet, or police people, that are going to your every single rental that a self-directed IRA person owns, just to make sure, who is painting that wall. But you just want to, just hire somebody, and then you've got a receipt to prove that you didn't do the work.
Great. Thank you so much. I mean, I won't be swinging any hammers anyway, nor will my husband.
And if anybody has another question and you want to ask me offline, you can always email me, and maybe MC would put that in the chat. It's info@udirectira.com, and happy to go deep on anybody's question.
Awesome. Yes. End of the day, though, it's very important that you not, cross mingle, commingle these things. Like, you can own a rental. Let's maybe dive into the sectors or the buckets of how you can own real estate in an IRA, right? So can I own a house in an IRA as a rental?
Yes.
Talk to me about putting a loan on that and things I need to look out for in that realm.
Yeah, and I always mention this when I talk about this, because coming from the residential lending side of the world, I was so surprised to find out that an institution would make a loan to an IRA account. Like, that seems nuts, but it's kind of a commercial loan. It's called a non-recourse loan. And what that means, I mean, there is recourse, but not against you personally and not against any other assets in the retirement account. So if your IRA took on a non-recourse loan and the IRA didn't make the payments, the lender could only come against the subject property, not against you personally, again, and not against any of the assets. Now, when an IRA does borrow money, any proceeds that the IRA earns because of leverage, not because of savings, but because of leverage, is subject to a special tax. So this is another topic where we go a little bit deep, and that tax is called unrelated debt financed income tax, or UDFI. And so it's not 100% of the rent, it's just the percentage of the rent that you receive because of leverage. So you got 30% leverage in the deal, 30% of that rent is taxable to you. You and your CPA sit down, you fill out a Form 990T, you get to take out any expenses, certain expenses that your tax professional will know what they are. So basically, you've got X tax, but then you'll diminish it by the expenses. And then your IRA files a 990T, and if any tax is owed, any expense from the IRA, it has to be paid for by the IRA. Any expense of an IRA asset is paid for by them. But leverage is a great way to move forward. Yeah.
Absolutely. You can buy a lot more with a little bit of leverage, right? Talk to me. Let's stay on the subject of owning a house. We're just going to own this one rental property in our self-directed IRA. What if I end up having to put on a new roof to this, right? Like, what are some things I need to keep in mind to do an update or any type of work on this deal that I own in a self-directed IRA?
Well, we have a great example fairly recently of somebody who did this wrong. The wrong way to do it is to go get a home equity line of credit and take your personal money and put that roof on personally. That is definitely something that's hard to unring that bell. That's tough. So you never use personal funds, but first off, you look to your IRA account or all the accounts together. And if you don't have enough, you can move some money into the self-directed IRA. So you've got enough for that roof. If you still don't have enough, you could make a contribution. And there are caps on contributions. So it depends upon your account type and your age and your income, how much you can contribute. You could also take on a loan or take on like a debt partner in a situation like that. But that's pretty much it. The money for the improvement to the IRA-owned asset has to be paid for by retirement dollars, IRA, self-directed IRA dollars from that account.
So again, the filter to think about this through is this an IRA going to benefit me in however many years, or can this benefit me today? Right? So it's in the future dollars or it's today dollars, and they cannot cross. The way I think about this too, and one thing that has shied me away from investing in a single property in a self-directed IRA is if I buy light bulbs, in theory, it needs to come from the funds of the self-directed IRA because it's intended for that, right? So talk to me, maybe are there other examples of things I need to be aware of in this situation of the owning of a house, owning of a single property in a self-directed IRA?
Yeah, I recently saw this reel on Instagram, and the lady was very, meticulous about, oh, it's the worst thing ever, and the fingernails and the whole thing. Anyway, so she was going on and on about it's the worst thing ever. It's not. I mean, because we've done this, right? We've all bought real estate and a rental property, and you think, hey, market is XYZ, I'm going to sell this thing, and you're like, I forgot, recapturing depreciation, ouch. Well, when it's in a tax protected bubble, like a self-directed IRA, there's no recapture because you never took a deduction because there was no tax. So there are serious benefits to putting real estate in a self-directed IRA, and that's one of them, as opposed to having that property outside of the self-directed IRA. It's just another way to build your retirement. So I think that's worth throwing out.
I love it. Well, this is actually a perfect question here. Pedro asks, what if I own this property in an account that's a self-directed IRA with a custodian, but I want to switch custodians? What do I need in order to make that switch?
It's, you have to go through a few steps. First, you open an account with that new custodian. You call the new custodian and ask them if they'll take that asset. And they're probably going to want to take a look at it because no custodian wants to accept a toxic asset. If for some reason it's in a, there was just a hurricane and all that, they know all the houses are sticks now, something like that. So they want to look at that first. Then you go through that. They say, yes, we'll accept your house. Then you open an account with them, and then you need to retitle the asset. And that's the responsibility of the account holder to go and retitle that asset out of the name of the old custodian into the name of the new custodian. And then, the custodian will walk you through that process. And then there you go. You can change custodians that way.
Couple of steps, but completely possible, it sounds like. So,
and logical too. I mean, for if you know real estate, you've got someone else is owning it. The titling has changed, so you have to change it.
Totally. Awesome. Well, tell me, this is a great follow-up here, Pedro. Talk to me about fee structures and maybe, lean on a little bit of what UDirect has to offer.
Yeah, I think one of the things people really like about our company is, besides our service, which we have like a little promo, plug here, we've got a 4.5 Google rating, which is pretty good for something like self-directed IRAs, which is something people don't inherently just understand. But our account holders really love our fees. I'm going to put that in the chat. It's because it is, our fees are a flat fee regardless of the number of assets and regardless of their value. It's not like a sliding scale. It's flat. So it could be $1 million, $100,000, same fee. You could have one asset in the account. You could have 10 assets in the account. It's the same fee. So there you go. So it's extremely affordable. And you can see, if you have a bounce check or you need something FedExed or I don't know, there's some special service that you need, there are fees for that. But otherwise, it's pretty straightforward.
Nice. Okay. It looks like we have a couple of solo 401k questions here. Differences between SDIRA and solo 401k and owning property. Does the solo 401k need to have an LLC to own the property, or is that just best practice?
I don't know if it's either, but with a solo 401k, it doesn't, neither an IRA nor a solo 401k have to have an LLC to own a property. You don't have to. You can talk about where you live. Every state is a little bit different. Find out if your retirement account has, that protection. We call it an anti-alienation provision, where it's protected from creditors. In California, not so much, but there are other states where retirement dollars are protected from creditors. So that's one thing to consider. It's something research to do. An LLC can give you certain liability protection. So that's something to consider. You can do it, but it's not required. It's just not required. And I know a lot of people sell these IRA-owned LLCs, called a checkbook IRA or something, and they make money from doing it. But whether or not you need it, you really want to think about that. But could it be handy? Sure, it could be very handy and easy to handle your transaction that way. But the way we've got things set up at UDirect is that we've got a portal, and if you need a bill paid, you just submit it online, and then we disperse the funds. It's really become streamlined over the years.
Makes it very straightforward.
To address our account holders' concerns. Well, I can't wait a week for the check. Well, okay, then let's just do it online.
Awesome, brilliant. Julianne asks, using a solo 401k in a syndication and then changing your custodian, is that a problem?
It's a matter of retitling the asset. You take it out of the name of the old custodian, and then the syndicator would help you retitle that asset into the name of the new custodian. And yes, we do that. We do that many times a week. That's very, very common.
Awesome. I want to kind of go back to our conversations of the ways that we can own real estate, because I'm largely a real estate investor, and I feel like most of our audience is largely real estate investors. So that is the vein, the rabbit hole I'm going to run down. So
Awesome.
We've talked about this owning a single property in a self-directed IRA, and the lending and the checkbook writing and all of the things associated with that. Let's kind of shift gears. You can buy into a syndication as a limited partner using self-directed IRA funds. Maybe talk to me a little high level about that.
Yeah, again, that is the #1 most popular asset class for the self-directed IRA account nationwide. And people just love it. It's nice to be able to get in as a little guy, something that the big guys are doing. You've got sometimes 25,000 if you're a sophisticated investor, if you're accredited, maybe more, but you can get into it. So basically, it's super easy. You first off, the hard part though is vetting the syndicator.
Mm-hmm.
Vetting that asset sponsor, making sure they're okay. And there are ways to do that. You want me to touch on that now because it's so
Sure,
important. Let's
do it.
Vetting a syndicator, what you want to do is, first off, you want to go to FINRA's website. It's called Broker Check. So FINRA is the enforcement arm of the SEC. And FINRA has a website called Broker Check. And you go there to Broker Check and you type in the name of the syndicator, because any syndication is promulgated or approved by the SEC. So they're going to be there. And you want to find out, hey, did they ever steal money from anybody? We had a situation where something was going on. It didn't look 100% great. So we went on Broker Check and we said, hey, what about the syndicator? And we just researched it ourselves and found out that it was a man, and this guy was actually barred from doing business at the SEC, and he was doing business. So we were able to address that and have that rectified on a higher level. So before you go, that's your due diligence. Check out these people you're investing with. Talk to other people who've invested with them. What was the customer service like?
I want to give you another resource to check syndicators. So if you go to this privateinvestorclub.com, you can go to the forums. This is intended for passive investors to basically share information about, deals that they've done. What is that person's experience? Because if you ask a deal sponsor for, referrals to talk to people who have done deals with them, you're probably going to get their aunt's phone number. If you want to get real information, this is a place that at no cost, or at least to my knowledge, at no cost, that you can start those conversations.
Well, that's brilliant, and I can go so deep on this fraud thing. But first you want to do your due diligence, and then what you do is you have the syndicator indicate your IRA name. It can be the titling can vary, but make sure that appears as the investor. It's not you investing; it's the IRA. So a special titling for the IRA as the owner, and then you give us the supporting documentation. You give us a direction of investment form, or just fill it out online. And then that gives us permission to disperse the money. You tell us how you want it dispersed. And then we send the money from your account into, or actually to that asset sponsor. Any proceeds from that deal come back to the IRA, never to you personally. And that's one of the things we're going to talk about later, like the biggest mistake. It's when the asset sponsor makes the check made payable to you personally. So if the asset sponsor makes a check payable to you personally, send it back because cashing that check would be a prohibited transaction. You're not supposed to have personal use of IRA funds. Or it could also be considered an early distribution where you could be fined and penalized. It could be considered a few things, but make sure the check is always made payable to the IRA.
Yes, for benefit of. Yes, awesome. So really, when you're investing in a syndication, though, you're buying shares of a business, of an LLC, right? So when you're filling out the paperwork, this is something, a decade ago, the first time I self-directed IRA funds and bought into a syndication, I thought I was buying real estate, but I wasn't, right? I was buying shares of this business. Yeah. So great. Okay. One thing on this buying into a syndication, though, there's tax benefits to owning rental real estate, right? And these larger deals over the course of the last handful of years have had a lot of benefit for doing these cost segregation studies and accelerating depreciation, the bonus depreciation that has happened. Talk to me about depreciation and when I have a syndication ownership in a self-directed IRA.
Right. So there are two. You always have a choice, and the choice can be, hey, I've got a bunch of money, I'd like to buy real estate, or I have enough to do this, or you don't. So when you're dealing with retirement dollars, I think it's a different question. I have retirement dollars. What do I want to do with these retirement dollars? Do I want to cash them out and pay all the tax now and use what's left to invest in real estate? You could do that. Is that the smartest thing? Talk to your tax person. You could also, but if you want to know what do I do with my retirement dollars, mostly the question is stock market or alternative assets. So what do you want to put it in? I think a lot of people like to put their money in asset classes that they know best. And I think a lot of those people on this call today know real estate, and they like to put their retirement and their savings into real estate. So basically, you're right. When you invest personally, there are lots and lots of tax deductions like cost seg and all this that don't necessarily carry over to the self-directed IRA world. Unless, like I was mentioning, you're going to come up against UBIT, unrelated business income tax, and you want to diminish that tax, where you would need some write-offs. Cost seg probably wouldn't help you too much, but yeah, I'm about to go down a rabbit hole, so I'm going to stop myself.
I know, I love it. But high level, if I'm investing in a self-directed IRA, using a self-directed IRA to get into a syndication, I kind of in many ways lose that opportunity to take that depreciation against my active income.
Correct. But then what you gain, I just have to say, you gain an asset in your retirement account that can grow tax-free in a Roth or tax deferred. So you're not paying tax on it. I mean, you're paying, the property pays property tax, but there's no,
right.
You're not paying, capital gains either. So
Absolutely.
you're saving there, and all the proceeds that come back can go out into your next deal, and so therefore you can compound faster because the gain isn't diminished by tax.
And the thing I loved most about getting into passive investments, LP positions with my self-directed IRA is I didn't feel like I was touching my liquidity that I needed to go be active in a deal, right? So I did, yes, lose that opportunity at that depreciation, but there were so many other benefits to investing in a syndication with my self-directed IRA. Talk to me about switching custodians when I have a syndication LP position.
Yeah, again, it's a matter of retitling the asset. You talk to the self-directed IRA company first. Hey, I'd like to, I want to move my account over, and they'll say, great. Then tell us more about your asset, because again, we're going to take a look at the syndicator and make sure it's not a toxic asset. Make sure we call it administratively feasible. We're going to make a business decision on whether or not we want to hold that particular asset. But as long as you get a green light, you retitle the asset sponsor can help you, and it's just you just move it over. So it's not difficult. But I have more to say about the syndication if I can add something.
Yeah, let's do it.
We were talking about UBIT, unrelated business income tax, UDFI, unrelated debt financed income tax. So if you are investing your retirement dollars in a syndication as an equity partner, you've got a little equity share there. First off, your IRA is going to get a K1. And that's something to be looking out for. And then you can send us the K1, and that's beautiful. The other thing is, if the syndicator is taking on leverage, your IRA very well have to pay some UDFI tax and file a 990T. So did the syndicator tell you that? When you were investing, did the asset sponsor say, hey, we've got this, part of our capital stack. Yes, it's equity partners from retirement accounts, but we're also taking on this tranche of debt. And so that debt will throw off tax to your IRA as a passive IRA investor. So definitely go in with your eyes open in a syndication deal and ask how much borrowed money, and so that you know what kind of potential tax consequence you might see to your retirement account. Now, in retirement accounts, they're income tax free, but this UDFI thing is a special tax. This for basically, it's for charities too. It's for nonprofit situations.
Is that payable annually or when we sell that asset?
It's payable annually. It's a year and a day. So, yeah, after. So, and again, discuss this with your qualified tax professional.
Disclaimer. I love it.
Yes.
Super cool. So this third way to invest in real estate with your self-directed IRA is currently my favorite. Loaning to people who flip houses, to people who own motels and need to refinance them for a bridge loan, things like that,
Hypothetically speaking.
Hypothetically speaking. So you talk to me about things I need to have in place if I want to serve as a private lender or a hard money lender with my self-directed IRA.
I got to say, I kind of love the loan in an IRA because for lots of reasons. I mean, you choose what's good for you, but here's why I like it. If your IRA is making a secured loan on a property, then if they pay you, awesome. If they don't pay you, then you foreclose and then you get the house. I mean, not that foreclosure is easy. I'm not saying it is, but I'm just saying that instead of the payments, you can have the house. So it's hard to really lose in a situation like that. And you just want to always make sure that you're getting into a loan where it's got favorable terms for you. You look at the loan to value and look at all the different risk factors. But loans are really great. Your IRA can definitely be the bank and lend money to others. And we see so many. Notes are the number 2 asset class, the lending of money, secured and unsecured debt.
I love it. And well, I love it particularly. And again, I am also not an accountant, but the only upside to being a lender is that income from the interest that you collect, right? And that is an ordinary income if you do it straight out of pocket, which is beautiful when it's done in a self-directed IRA, because then you don't pay any of that higher level tax that you would be exposed to if it was just your, normal pocketbook that you were lending from.
And it's also fun. Yeah, absolutely. And it's also a great way to, do good things. Like Mandy and I are in a group together. And if you could, like maybe you're in a group of people that do investing, and then what you could do is lend each other money, and just boost and do good things for your friends. I mean, help them grow. It's where we can all lift each other up, grassroots kind of style.
I love it. I always say that you're given 2 arms for a reason, right? One to pull yourself up, but one to pull other people along with you. And that is why I love you so much. Tell me maybe a little bit, let's dig into big mistakes that you see happen. We've touched on a lot of them, but maybe, let's summarize, let's kind of maybe go a little deeper into the mistakes. And then we're looking for questions, guys.
Yeah, I would love to hear a question, especially if somebody's had an experience with self-directed IRAs that they want to share. It'd be super interesting. But I think the biggest mistake is having the asset sponsor send the proceeds to the account holder directly. So that's number one, just so easy to avoid, because you tell your asset sponsor, this is how the check is made. And if you get it, you just return it. So you've got total control over that not happening to you. But we've seen other things with, like we're talking about single family rentals, especially like about 2013, 14, when people remember we were buying properties on tape. Those were the days, weren't they? And so we had this actual attorney, and he was having the renter make the rental checks payable to him, and then he was putting them in his personal bank account. But then we said, when we found out, and we were talking to the guy, like, why are you doing this? He says, oh, it's no problem, because I am putting it on my 1040. I'm filing taxes. I'm declaring the income. It's like, it doesn't work that way. It does not work that way. You've taken constructive use of your IRA. It's just it's a mess. And so don't do that. Never take money in your personal name.
Yeah.
You know, that's one of the biggest mistakes I can think of. But I think not doing proper due diligence, and also thinking, oh, here's another thing, thinking that just because it's a passive investment that you are a passive investor. You're not. Maybe you don't swing the hammers. I mean, you know, like we're talking about with Jeannie, maybe you're not, which she's not going to do. Maybe you're not just sitting back in your easy chair collecting checks, but you better be checking on that asset sponsor. You better be contacting them and making sure you're reading what they give you and ask questions and be active. Because if you care about that money, you let them know you care and stay active and say, you know what, I read your report, but I had a question about something. Don't just sit there and be passive, because they could be telling you all these things, and then, you know, now it's a maturity date and you're asking questions. Oh, well, we told you about that 6 months ago, and you were passive. You didn't bother to get involved in the investment, and you didn't see what they were telling you. Oh yeah, we had this problem and we have to do this, or, you know.
Are there differences in terms that I can loan out through my self-directed IRA? Is there like a maximum number of months that I could have a loan out for?
We're not going to dictate the terms. It is self-directed. As long as it's legal in the state, you know, like not usurious, and it's legal. What we do require, though, is this.
Define that for me, usurious. If someone hasn't lent before, that might be new to them.
Sure, usury is a felony, or it's a crime anyway. As far as I know, I'm also not a crime fighter professionally. Yeah. So it's just charging too much interest is what it means. Usury is interest that's too high, that's considered.
And
like,
every state has a maximum.
Yeah.
So if you are lending in a state, so I'm in Illinois, you're in California. If I'm lending you money, I need to know what that usury rate is in both states. If the property is in a third state, you also want to know the usury rate where that property is too. So great information. Can multiple, go ahead, sorry.
Well, I was just going to add, because it's really important that that regarding notes, we want to see the elements of a note. I mean, long gone are the days when you can just, like the napkin note, like, oh, hey, we're just going to do a handshake deal here. We're buddies, and my word is as good as gold. You know, well, that's fine, but this is business. So what we're going to do is write up an actual note. It's going to have the principal amount. It's going to have the interest rate. It's going to have the term. It's going to maybe, you know, throw in an amortization schedule, and it's all going to be laid out what the terms of that note are. And we have to have payments. It's not, we won't accept a loan with balloon payments, because what we saw is a lot of bad actors, you know, that's what we call criminals before they were actually convicted. Bad actors kicking the can. Well, yeah, it's a 10-year balloon, but we're going to extend that balloon. And so here you've gone 10 years without a dime on your investment. Well, that's not really an investment, is it? If you give someone your money in 10 years, you get nothing back.
Yeah.
That's so
charity.
we won't take a balloon loan. So we want to see at least an interest only payment, at least, you know, once a month, or monthly or quarterly. Yeah.
Great information. Can multiple self-directed IRAs own the same property?
Yes, absolutely. Yes, you can.
Tell me, let's go a little deeper there. So if I own one with $100,000 and one with $50,000, things I need to be careful about.
So you're talking about two investors going together?
So if Mandy McAllister has two self-directed IRAs,
yes,
for whatever reason.
Yes, then it would be like, you know, Mandy's traditional IRA, say 70%, Mandy's Roth IRA, 30%, tenants in common, perhaps. And then if it's real estate, and then what happens then is the renter, if they say it's a property and there's a renter, then the renter would have to make two rent checks, one to your traditional and one to your Roth. And the same thing, if the property tax is due, Roth pays 30% of the property tax, traditional pays 70%. So when you have a property manager in real estate, they can do this for you, where the renter can just pay the property manager directly, and they don't have to split hairs like that. But anytime when there is multiple ownership, then you have a situation where all the bills and all the proceeds have to be split pro rata.
And you've got to be very careful of that math to avoid any prohibited transactions.
Yeah.
Awesome. I hope that cleared up what you were looking for. So do I have any other questions from the gallery that we have not yet covered, or I will continue to ask things that I'm curious about? Go ahead and raise your hand or put it in the chat and we will help you come off of mute. Tell me, you know, about, I've got to assume that you've got self-directed IRA funds, right?
Yes.
Karen? What
Yeah.
what types of investments do you have in your?
Well, for example, I have this, when I very first started the company, that's what I thought, well, if I'm going to be the founder of a self-directed IRA company, I better have one. So I invested in this REIT and a passive real estate investment trust. It's REIT for anybody who doesn't know. And it's another great vehicle for an IRA because it's passive and it's really arm's length. So that's what I did. And it was the underlying asset of this REIT was senior living. So I invested in it, and it was 2009. And as the years went by, I didn't know who to contact. I mean, because I'm an average. I should like the shoemaker's kids don't have shoes. So I think, well, it's not a good investment. But it turns out that like 10 years later, I get this monstrous check. This like more than I invested came back. It was amazing. I mean, the return was so amazing. So that was a really good thing. It taught me a lot. It taught me to make sure I do my, that I keep better track of my own stuff, not just everybody else's.
Right.
And also that these deals, there a lot of times they're long-term hold. So make sure that the next time I invest, I understand how long the hold time is. So I learned a lot of things from that. So it was great, and it's in a Roth.
Yeah.
And so now I make too much money to contribute to a Roth. That's another thing about Roth IRAs. You can make too much and you can't contribute. You can always move the money over. Yeah, you can always do that.
Backdoor.
Yeah, you can backdoor the IRA for sure, the Roth IRA. But anyway, so that was something that I invested in, had an amazing return, taught me a few lessons. And that was early IRA days.
Awesome. Dina Carr, I don't know if I'm saying your name correctly. I'm going to have you come off mute. It sounds like there's a specific circumstance that you want to make sure that you get information around. Are the rules different in the self-directed IRA is owned by multiple people investing in the same property? So Dina Carr, will have you off mute, please.
Yeah, thank you. I was following up on my previous question. What if two different individuals owning self-directed IRAs, separate self-directed IRAs, invest in the same property? Are the rules different from what was mentioned a short while ago in terms of splitting the rent check and expenses and so on?
No, they're precisely the same. In fact, when two people invest in a property, they'll close concurrently with their names on title, at the same time. And this brings up a really interesting point that even disallowed people, this is an exception to the rule, but even people like a husband and wife, mother and son or whatever, they disallowed people can invest in a new deal concurrently as long as they do so simultaneously. So they had no prior interest in the asset, but they come in, they close concurrently like on real estate. You can do this. But again, you're always going to receive the proceeds pro rata and pay the bills pro rata. And that can get a little tricky with real estate, I have to say, because like with property tax, they want the whole amount in one envelope. They don't want two partial payments for a parcel. So you just need to know where the property is, what that tax collector wants. So that's what you need to know. But no, there are no special rules. Just make sure that proceeds and expenses are split pro rata.
Great.
Thank you.
Awesome. Glad we cleared that up. So it sounds like, Dina Carr, you need to contact Karen about that. Toby, we're going to have you ask your question. If a solo 401k, the amount you were allowed to contribute is higher than the self-directed IRA, do your proceeds from the syndication go towards that annual limit?
No, because proceeds are one thing and contribution limits are different. So a contribution amount is something that comes out of your checking account personally, and you contribute your own personal dollars to the account. But and so there's a cap on that. There's a cap on how much you can contribute. Proceeds are uncapped. Your IRA can earn just, unlimited amount of proceeds, and I hope you do. So proceeds are different than contributions, and proceeds are not capped.
Awesome. You got what you needed? Great. Thank you, Toby. Awesome.
I hope you have that problem.
Right? That would be a lovely problem to have. I have entirely too many proceeds. That's my
to do.
Diamond shoes are too pinchy, Karen. Do we have other questions from the gallery? This has been tremendously helpful to me, figuring out when partnerships especially can invest alongside each other. That clarification was something that I think is incredibly necessary, especially for the people that I have the opportunity to mentor. That you make a big mistake. Actually, let's run this through. Let's say I did make a prohibited transaction. What do I run into? What do I if I can't unwind it? What tax ramifications does that have?
Okay, so I literally wrote an article about this yesterday, so I'm going to throw it in the chat. So let's talk. So what you have to do is just try to correct it as soon as possible. There's the article if you want to go deep on that. But say you can't fix it, and it truly is a prohibited transaction. IRS says they reach out to you, you've committed this prohibited transaction. Now you're dealing with the IRS. What will happen in the worst case scenario is that the tax protected bubble of the IRA or solo 401k or whatever bursts, and now that money is taxable to you with penalties and probably excise tax, and it loses the tax protection. So then it lost the tax protection, but then you go back to the date of the infraction when the infraction occurred, and you owe back taxes and penalties on the money. So it can get messy and expensive when you really commit a prohibited transaction. Otherwise, I think the IRS over the years has become more lenient. Just fix it as fast as you can. But if you get into a real situation, that's the worst thing that can happen. And sometimes people will notice that something wasn't perfect and they fix it, and maybe they sell the property and they liquidate the asset and they just get rid of it. That's another thing that people will do. It's like, oops, I made a mistake and let's start over again. But again, here's what the IRS says about prohibited transactions and how to deal with them. They're much more lenient now than they were 17 years ago.
Awesome. I mean, this is fantastic, Karin. I am so grateful. 1, for your time, 2, for your brilliance, and 3, for your friendship. We'll be sending out a recording of this call and the article that Karin recently wrote. Again, if you need to contact UDirect, info@udirect.com. We'll get you in touch with the custodian. Karin, thank you so very much.
Appreciate it, everybody. Thanks for your time.
Bye-bye.